this just kind of explains everything you need to know about a credit spread, big picture brokerage, things that I want to do. Like if you don't care about what something looks like, but you want to see like stuff that I was really thinking about, like this is what it's about. So let's go ahead and find what I'm looking for before we get too crazy. Oh, that's the big opportunity plus margin. Goal list insurance. Insurance policy. Not exactly sure what that was about. Actuary combo. Looks like I got a lot of stuff in here. Video progress. Huh. Feel like I'm missing something. Interesting. So, oh, maybe it's in here. Toad's got to be in here. Nice. I'm so smart. I freaking wrote down everything. Here we go. Boom. Check this out. When you're calculating in, like, so if you're looking at an option, right? Any option in the whole stock market right now today, if you're looking at that bid ask price, you basically have to pay the ask price to buy it. That's how much it's going to cost you, okay? You have to pay the ask price to buy it. If it expires on expiration day out of the money, whatever that ask price is, you lose 100% of it, okay? Every penny above that strike price that you chose, that it goes in the money at expiration, is worth 100 times a penny, which is $1, times the number of contracts that you purchased. So if we're just doing, now pay attention, if we're just doing one contract for each of these strikes, check this out. All right, let's make sure I got this right. Three times 1%, so that's 1% minus 324. Okay, that's what, that makes sense. That makes sense. Okay. So this is how much each contract costs for these strikes, right? The numbers I'm about to show you represent one contract per strike. So if the stock market went up 1% when the stock price was at $323 and the strike you bought was $324, you would lose $47. So basically, you would lose almost all of your 270. If we went up 1% of above 325, you would lose $96, most of your investment. And then all the way to this point to where the most, so this number is actually wrong, so don't even worry about this number because the number is actually, this is the most it can be. So this is your technical loss unless it's greater than this number, then it's just this number. And so in all of these examples, this is the most you could lose in this column right here. And then we see this 2% example. So if the stock is going to move 2%, what we see is that 325 is the best strike to do at the money at expiration. You get 104% return on your money of your $219 investment. And then all the way here, 2%, you're out of the money. So again, you're losing whatever's in here because you're out of the money, so you lose. Now, if it went to 5%, your $270 grows to $1,245. one contract grows 461%. Your 325 strike grows to 500%, or grows 546% to 1196. Your 174 contract grows to 1141. Your 136 contract goes to 1079. So even though it's less profits, it's actually a greater ROI, because think about it. If it's 270 here, that means I could have bought two contracts at 327, which means I would have made $2,160 rather than just the $1,245. Think about this, guys. So if we keep going down this path, on the $8 freaking option of a strike at 336 and a 5% movement, my $8 turns into $307 for a 3,837% ROI. That's how I made the 160x, because I had a better opportunity than the one I'm showing you here, and it went up way more than 5%. Oh man, so that 160x percentage wise looks like 16000%. So it's 16,000%, which is freaking 4 times as much as this right here, which is the number one in this SPY example. So like, that's just to give you like a little taste of what we're going to be doing with the options, how to really understand the options, why you want to really make the money, and why buying a deeper out of the money option only makes you the most money if it moves a lot. If it only moves 3%, buying a closer in the money option is the one that's going to make the most money.